Welcome to Supernova Stock Watch. Covered calls are an options strategy that can provide some financial protection during challenging market conditions. When an investor with a long position in a particular asset sells a call option for that asset, generating a profit in the process, it is considered a covered call. A key to the covered call strategy is that the call buyer is obligated to pay a premium. That means more minor losses when it decreases in value, but the seller can still benefit if it increases in price, provided the calls were out of the money. Covered call writing was once available only to the wealthiest investors, but it is available for everyone, thanks to ETFs. Covered calls usually generate income for an investor in a slower, safer way than market timing or purchases of shares. Potential for higher returns. A study by the CBOE found that a strategy of buying the S&P 500 and foregoing option premiums resulted in better returns than just investing in an S&P 500 index fund. The study showed an 830% return to the at-the-money covered call strategy between June 30, 1986, and December 31, 2011. During that same period, the S&P 500 went up 807%. The strategy's success is rooted in the fact that covered calls on the S&P 500 get more valuable when volatility rises. The VIX index measures volatility, also called the fear index, because it increases during high uncertainty and risk periods. When one considers what a call option does, it is only natural that its value would go up when anxiety is high. A call option allows the buyer to get all the security gains with none of the downside risks during a specified time. Since perceived risk and real rewards tend to be correlated, the call option buyer's low risk results in pretty low returns in the long run. The call option seller, who takes a high risk of loss with limited potential for gain in any given month, does much better in the long run. Guarding against volatility. Partly due to increased returns when market volatility is high, a covered call approach is usually considerably less volatile than the market itself. Over a long time, the strategy of buying the S&P 500 and writing at the money calls had about 30% less volatility than the S&P 500 itself. Particularly in an unstable political climate, covered call ETFs can be an excellent way to ride out riskier periods in the market while still bringing in a profit. A different pattern of returns. Covered call ETFs are a sensible investment choice if you want to make steady growth over time. However, they will look very different from the S&P 500 during bullish or bearish years. Generally, they will tend to lag when the market advances slowly and steadily. Fear and volatility are high during bear market periods. Selling covered calls can help to reduce losses. They also allow you to earn a decent return from the stock market after a crash, when securities prices are low and volatility is high. The lower volatility of covered call strategies makes them such a popular investment choice. It also means that their returns are similar to the S&P 500, so it's better to risk adjust for the lower volatility. ETF simplification of covered calls. Covered calls are based on a simple principle but have more complications than more straightforward investing methods. Covered call options are a great investment opportunity for investors, but many people are hesitant to get involved because the concept intimidates them. One significant benefit of a covered call ETF is that it simplifies the process for investors. An ETF like qyld uses Nasdaq 100 index options, which can't be exercised early. These types of ETFs also receive more tax-efficient treatment. All of this is to say that covered call ETFs take a lot of the detailed work of investing in this area out of the individual investor's hands and place it under the care of teams with specialized expertise. Going to look at 4 covered call ETFs that takes advantage of the Nasdaq 100, the S&P 500, Russell 2000 Index, and the Dow Jones Industrial Average. Number 4, Global X Dow 30 Covered Call ETF, ticker DJIA. The Global X Dow 30 Covered Call ETF follows a covered call or buy-write strategy, in which the fund buys the stocks in the Dow Jones Industrial Average, also known as the Dow 30 Index, and writes or sells corresponding call options on this index. The Dow Jones Industrial Average is a price-weighted measurement stock market index of only 30 prominent companies listed on stock exchanges in the United States. This is a relatively new ETF since its inception date on February 23, 2022. The top 10 holdings are United Health Group, Goldman Sachs, Home Depot, Microsoft, McDonald's, Visa, Amgen, Boeing, Salesforce, and Caterpillar. It paid its first monthly dividend on March 29, 2022, of 22 cents per share. A $300,000 investment would provide you with 11,843 shares, equaling a monthly payout of $2,642.17. Number 3, Global X Russell 2000 Covered Call ETF, ticker RYLD. The Global X Russell 2000 Covered Call ETF follows a covered call or buy-write strategy, in which the fund buys exposure to the stocks in the Russell 2000 Index. The Russell 2000 Index is a small-cap stock market index that makes up the smallest 2,000 stocks in the Russell 3000 Index. It is the most widely quoted measure of the overall performance of the small-cap to mid-cap company shares. The index represents approximately 10% of the total market capitalization of the Russell 3000 Index. This ETF has $1.24 billion in assets under management, has a 12-month trailing yield of 13.56%, and the last monthly dividend paid was just over 22 cents per share. A $300,000 investment would provide you with 12,615 shares, equaling a monthly payout of $2,815.66. Number 2, Global X S&P 500 Covered Call ETF, ticker XYLD. The Global X S&P 500 Covered Call ETF follows a covered call or buy right strategy, in which the fund buys the stocks in the S&P 500 index and writes or sells corresponding call options on this index. The Standard & Poor's 500, or simply the S&P 500, is a stock market index tracking the performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices. As of December 31, 2020, more than $5.4 trillion was invested in assets tied to the performance of the index. This ETF has $1.35 billion in assets under management, has a 12-month trailing yield of 10.12%, and the last monthly dividend paid was over 48 cents per share. A $300,000 investment would provide you with 6,041 shares, equaling a monthly payout of $2,904.51. Number 1, Global X Nasdaq 100 Covered Call ETF, ticker QYLD. The Global X Nasdaq 100 Covered Call ETF follows a covered call or buy right strategy, in which the fund buys the stocks in the Nasdaq 100 index and writes or sells corresponding call options on this index. The Nasdaq 100 is a stock market index made up of 101 equity securities issued by 100 of the largest non-financial companies listed on the Nasdaq stock market. It is a modified capitalization weighted index. The stocks weights in the index are based on their market capitalizations, with certain rules capping the influence of the largest components. It is based on exchange, and it does not have any financial companies. The financial companies are in a separate index, the Nasdaq Financial 100. This ETF has over $7 billion in assets under management, has a 12-month trailing yield of 13.78%, and the last monthly dividend paid was a little over 20 cents per share. A $300,000 investment would provide you with 14,374 shares, equaling a monthly payout of $2,917.92. Bottom line, if you are looking for monthly passive income, covered call ETFs are a great option. Covered call ETFs are a sensible investment choice if you want to make steady growth over time. I enjoy sharing my insight with you and helping both of us become better traders and investors and find some level of success. You have made it to the end of my video. Thank you for watching. Please check out my other videos and the description for great deals and sign-up bonuses.